Have you ever wondered which is a better investment? Cryptocurrencies or stocks? It's a question that has been on the minds of many as the financial landscape continues to evolve at a rapid pace. With the advent of technology, investing has moved well beyond the traditional realm of stocks, bonds, and mutual funds. Cryptocurrencies, digital or virtual currencies that use cryptography for security, have emerged as a new and exciting frontier in the world of investing. This has led to a fascinating debate among investors. Should one stick to the tried and tested path of stocks, or venture into the relatively unknown world of cryptocurrencies? Each comes with its own set of benefits and drawbacks, risks, and rewards. It's crucial to understand these before making an investment decision. In this video, we will discuss the benefits and drawbacks of investing in cryptocurrencies versus stocks. So sit back, relax, and let's dive into the world of investing. Before we dive into the comparison, it's important to understand what cryptocurrencies are. Cryptocurrencies are a type of digital or virtual currency that use cryptography for security. They are primarily built on a technology called blockchain. A blockchain is a decentralized technology spread across many computers that manage and record transactions. This decentralization is one of the key aspects of cryptocurrencies. It means that no single institution controls the currency, giving it resistance against potential interference or manipulation. Now, let's talk about how cryptocurrencies work. When you send someone a unit of cryptocurrency, say Bitcoin, your transaction is bundled together with others into a block. This block is then added to a chain of previous transactions, hence the name blockchain. The transaction is considered complete once the block is added to the chain. This process is overseen by miners who validate and record each transaction on the blockchain. One of the most defining characteristics of cryptocurrencies is their volatility. Prices can skyrocket or plunge in a matter of hours. This volatility can present both opportunities and risks. On one hand, it can lead to significant profits if a cryptocurrency's value surges. On the other hand, it can result in substantial losses if the value drops. It's this roller coaster ride that attracts some investors and scares off others. There are thousands of different cryptocurrencies available today, each with its own unique properties and uses. Some, like Bitcoin, are primarily used as digital money. Others, like Ethereum, are used to power decentralized applications, or dApps, on their network. Cryptocurrencies are a revolutionary technology that have the potential to disrupt traditional financial systems and even change the way we conduct business, but they also come with their fair share of risks, including price volatility and regulatory uncertainties. It's important for anyone considering investing in cryptocurrencies to do their research and understand these risks. Now that we have a basic understanding of cryptocurrencies, let's move on to stocks. Just like cryptocurrencies, stocks are another form of investment. Now let's dive into the world of stocks. Picture a stock as a small slice of a company's pie. When you buy a stock, you're essentially buying a piece of that company. You become a shareholder, owning a fraction of the company's overall worth. However, unlike a piece of pie, stocks aren't just about grabbing a bite of a company's profits. Your slice can grow or shrink, depending on the company's performance and the market's perception of its value. This is where the concept of volatility comes into play. Volatility, in the context of stocks, refers to the rapid and significant price movements that can happen within short periods of time. It's a measure of the rate at which the price of a security increases or decreases for a set of returns. Stocks can be highly volatile, and while this can provide opportunities for substantial returns, it can also lead to significant losses. Now, imagine a bustling marketplace where these slices of pie or stocks are bought and sold. This marketplace is what we call a stock exchange. It's a physical or virtual place where sellers meet buyers. The New York Stock Exchange and the Nasdaq are examples of such marketplaces. The role of these exchanges is to provide a transparent and regulated environment where stock transactions can take place. So when you decide to buy or sell your shares, these exchanges match you with a buyer or seller respectively. Remember, when you invest in stocks, you're placing a bet on the company's future. If the company does well, your slice of the pie grows bigger, and so does your investment. However, if the company doesn't perform as expected, your slice may shrink, potentially leading to losses. This dynamic nature of stocks makes them a thrilling, yet risky, form of investment. It requires careful consideration, thorough research, and quite often, a willingness to ride out market fluctuations. Now that we have a basic understanding of stocks, let's start comparing both. So, cryptocurrencies or stocks? Which is a better investment? Well, let's start by saying that both investments have their own unique features, and what might work for one person may not work for another. It's all about aligning your investment choice with your financial goals, risk tolerance, and investment horizon. Let's take a look at cryptocurrencies first. They are known for their high volatility. This means the price of a cryptocurrency can change rapidly in a very short time, making it possible for investors to experience significant gains or losses. Investments in cryptocurrencies like Bitcoin, Ethereum, and others are speculative and involve a high degree of risk. On the upside, cryptocurrencies can offer incredible returns. Just imagine, if you had invested $100 in Bitcoin back in 2010, you'd be a millionaire today. Cryptocurrencies also operate 24/7, meaning you can trade anytime, unlike stock markets which have specific trading hours. However, this high reward potential comes with high risk. Cryptocurrency markets are highly unpredictable. Also, they are less regulated than traditional financial markets, which can bring additional risks like fraud or hacking. Now let's shift gears to stocks. Stocks represent ownership in a company and entitle you to a portion of that company's earnings and assets. They are a tried and tested investment avenue, and have been around for centuries. Stocks can offer steady returns over the long term. If you look at the historical performance of the stock market, it has provided investors with an average annual return of about 7 to 10%. They may not offer the dramatic returns of cryptocurrencies, but they are generally less volatile. However, stock prices can be influenced by a plethora of factors, from company earnings, geopolitical events, economic indicators, to market sentiment. Also, investing in stocks requires a good understanding of the business landscape and the company you're investing in. So, cryptocurrencies or stocks? Well, it seems like a toss-up between stability and potential, between tradition and innovation. With stocks, you have the potential for steady growth and dividends, backed by tangible assets and a long history. With cryptocurrencies, you get the lure of explosive growth, the excitement of a new technology, but also the risk of extreme volatility and potential loss. As we can see, both have their own sets of benefits and drawbacks. The choice depends on your personal investment goals, risk appetite, and how much volatility you can stomach. It's always a good idea to diversify your portfolio, and maybe, just maybe, it would be wise to have a bit of both. The stability of stocks and the potential of cryptocurrencies. So, what should we take away from this comparison? We've delved deeply into the world of cryptocurrencies and stocks, unraveling their intricacies, benefits, and drawbacks. It's time to recap the critical points of our discussion. Cryptocurrencies, as we've explored, provide a unique opportunity for immense growth and potential returns. Their decentralized nature offers freedom from traditional banking systems and governmental control. They also enable quick and easy transactions across borders, making them an attractive proposition for the tech-savvy, digital-era investor. However, the volatility of cryptocurrencies is not to be underestimated. Prices can skyrocket or plummet dramatically in a short span, making it a high-risk, high-reward investment option. On the other hand, stocks represent a share of ownership in a company. Investing in stocks has been a time-tested method for wealth creation. They offer the prospect of regular dividends and potential capital appreciation over the long term. Stocks, generally, are less volatile than cryptocurrencies. But remember, their performance is closely tied to the company's health and the overall economic conditions. Consequently, they may not be immune to market fluctuations and economic downturns. The choice between cryptocurrencies and stocks, my friends, is not a one-size-fits-all answer. It's a decision that should align with your specific investment goals and risk tolerance. Are you a risk taker, prepared for the roller coaster ride of cryptocurrency prices for potentially outsized gains? Or do you prefer the relative stability and steady growth offered by stocks, accepting the intertwining with economic conditions? It's also worth considering a balanced portfolio which includes both stocks and cryptocurrencies. This approach can provide the best of both worlds, allowing for potential high returns from cryptocurrencies while maintaining a level of stability with stocks. Remember, investing should never be a game of chance. It's about making informed decisions based on thorough research and understanding. In the end, the choice between cryptocurrencies and stocks comes down to your personal investment goals and risk tolerance. Always keep this in mind as you navigate the exciting world of investments.